So hello and welcome to yet another session. And today we are going to learn about quant investing. Today we have with us the founder of Wright Research, Sonam Srivastava, who has begun the journey of the entire research process into the quant side of things. She has been running this firm since November 2019. And earlier, she has been working into multiple MNCs, including HSBC, has been trainer in BSc also. And she was also awarded as top 100 women in India by the agency called AIWMI. So welcome Sonam here, and great to have you on this particular session where we are going to discuss about quant investing, and who is better than you to talk about this topic. So great to have you here.
No, thank you for having me, Vivek. I'm so excited to talk about quant investing in this session. And thank you for the introduction.
Superb. Thank you so much. And first of all, let us know about your investing journey, like how you started and what were the steps which you took in your career and reaching to this stage of establishing Wright Research.
All right. So talking about my journey, I started my career in quant finance in 2012, which was fortunately very close to when, algo trading started in India in 2010. So I had a lot of opportunity in experimenting and doing a lot of, research work and interesting work in the Indian market. I started my career with Forefront Capital Management, which was a Mumbai-based investment manager, and we were doing a lot of good quant-based stuff out there, algo trading and things like that. And this particular firm got acquired by Edelweiss, and I joined the Edelweiss algo trading group, where I used to work in the institutional desk and did a lot of high frequency trading, execution trading for large mutual fund clients. So that was a very good learning curve for me. But I always wanted to do proprietary strategies, stock selection, fund management, things like that, right? So that was more of a passion for me. So I got an opportunity with HSBC Global Markets in Bangalore, where Vivek, you were also there, and I got a chance to work on very interesting longer term quantitative strategies, factor based models, which really created that passion in me. And after HSBC, after a few years in HSBC, I started with a startup called Qplum, which was doing investment advisory in the US. And after that startup quickly shut down, I sort of moved to build my own advisory in India. And I wanted to approach the mass market, not keep it focused only to large institutions. Wanted to take quantitative investing and what we were doing, what is the credit of it, to the broader market, democratize that access. And we launched some very good, interesting quantitative factor based products that a lot of people use right now. And the journey has been amazing. And what is really exceptional is that right now, because digital and fintech has increased so much, people trust data-driven investing more and more. People are ready to invest, in platforms like Smallcase through their phone, right?
Yes.
So I think, So I think, so I was fortunate enough to start when this really took off, right? Which was in 2020. The digital advisory really took off, and I started around that time, and we've seen a lot of growth. And I really love that our investors show to us. And I would like to talk more about that to you.
Superb. So let us know how this entire idea of Wright Research evolved. Like, you might have thought that I would start my own, and you wanted that entire system driven or rule based strategies to be deployed. What is that emergence of the thought process? That okay, this is how we want to do, and this is how we want to run the Wright Research.
So the idea of the portfolio, which was something that I started with, was factor strategies and multi-factor strategies.
Yeah.
This is something that I had been experimenting, even when I was in HSBC and Qplum, right? I had been experimenting with regime models and factor models, not for India at all, but for other markets.
Yeah.
So I, took that same philosophy. And when Qplum was shutting down, I started experimenting on my own. If I can set something up, I saw that, there's a good backtest that I have. There's a lot of credit to it. It is well validated.
Yeah.
So why not do it? Now, I have a good hold on the product side of things, right? That I know how to create strategies and, work on them. But on the market side, where how do you approach the market and how do you find clients, that piece I didn't know right when I started.
Yes.
So I sort of thought that I would be able to go to wealth managers and probably find clients, right? That was what my thought process was. But once the pandemic hit, that became impossible for a new person, right?
Mm, mm,
Nobody would look at you. So fortunately, at that point in time, small case really took off for us, right?
mm.
People, our portfolios were not giving very bad returns during that crash. People were looking at us, and eventually, from there we saw the growth really pick up, and then now our approach has been more digital for the last couple of years, which is working for us and which is what we want to continue, right?
Superb.
Yeah.
Superb. So let us know about how do you go about selecting the stocks, and what is the thought process on screening your ideas? Like, you have multiple portfolios, but
Right.
what is the starting point, and then how do you actually come down to that list of 20-25 stocks in your portfolio?
Yeah. So I'll share a little bit on this on
Yeah,
my screen.
sure.
Uh, so our idea is that we try to describe the market using a number of factors. We understand that no one thing can describe the market. Market is made up of so many different things, right?
Yes.
So many themes, so many events, so many players, right? But we broadly believe there are two types of things that can help you do well in the market. One is understanding the macroeconomics, right, which is the market wide factors. How will the inflation, how will the GDP rate, things like that influence the market. And second is factors, right, the styles of investing, right, which is like I said, momentum, value, growth, quality, volatility, etc. So these are the various factors that describe the market return. And we follow a purely data driven approach, right? It is purely algo driven or data driven. And the idea is that there are a lot of entry points, which is data, right?
Mm-hmm.
Now a machine will do nothing but is as good as the data that it is getting, right? It
Mm-hmm.
will do act based on the data that it is getting. So we
Yes.
try to get good quality data on fundamental ratios. Like when I say we are looking at a momentum factor, then we are looking at the trend prices. When we are looking at the value factor, we are looking at valuation ratios like P, PBV, etc. When we are looking at some other factor, we are looking at other ratios, right?
Yeah.
So we try to get as much of that data as possible. Then we try to optimize so that we are maximizing the exposure to one particular factor, right? So this is our portfolio construction engine, which gets the data, tries to maximize. If you're creating a value portfolio, it will maximize the exposure to high value stocks, right?
Mm-hmm.
But it will also reduce the risk that you are taking.
Yes.
And also, if because you're doing it on multiple periods, we also try to reduce the cost. We don't want to trade too much, right? It is a slightly passive portfolio, slightly long only portfolio. So that is the data driven approach, and there are various nuances to it that we can go into later, I think.
Superb, superb. So once you select the stocks based on all these criteria, what is the allocation process? Like, how do you go about allocating into a particular stock? Do you rank them, or you have equal weighted portfolios? How do you follow the next allocation strategy after that?
So let's
And if at
just
all there is any sector based approach also, that
yeah,
would be
yeah.
interesting
So
to know.
yeah, so the first thing, like I said, is finding out a particular ratio that you're going to work with, right?
Mm-hmm.
Which is like I said, on based on various factor that you're choosing, there is a well defined ratio that you could be looking at, right? So for like a price to book for value or earning yield, etc. But when you're going to construct the particular portfolio, there are a number of ways to doing it, right?
Mm-hmm.
I mean, a very simple way is that you identify top 10 momentum stocks, give them equal weight, and go ahead with it, right?
Yes.
That's a basic
Yes.
way. But then there are a number of other quantitative methods of allocating, right? So we use our own allocator, which tries to maximize the performance while reducing the risk, right? That is what we are trying to do. So it is like a again a optimizer, a machine driven optimizer, that gets the data, looks at the covariance matrix to minimize the risk, and looks at the return values to maximize those returns, right?
Yes, yes.
And so
I
that is the
remember doing some sort of these things in my MBA, some VAR cover
yeah. I
ratios, and then
think
you optimize and
everybody
you have to put constraints and a lot of
yeah.
amazing stuff.
Yeah,
Awesome.
even, in HSBC, I used to do a lot of this, right? They had a software for it.
Superb. So basically, then you, based on the factor, it decides your allocation, and then what is the strategy in terms of position sizing? Like, do you increase the size of the position during your journey if there are some winners emerging, something which is not working out? How does that dynamic allocation takes place after that?
Yeah, so I think we don't, specifically do any, even a stop loss, stop profit, or, increasing the allocation or anything in this particular strategy.
Mm-hmm.
But what we do here is on a monthly basis, we are rebalancing it, right? On a
Right.
monthly basis, I rebalance it, and every time I rebalance, the weight to a particular security can vary, right?
Mm-hmm.
Depending on its performance in the last month, let's say, or the risk in the last month, right? So the idea is that we are looking to reduce the risk to any sector or industry, or reduce exposure to any particular factor, but we keep our and when any single stock will not have more than 10% allocation, any single sector will not have more than 20% allocation, but generally it will be it totally comes out from the model, right? We put
Yes.
some constraints, but it comes out from the model. Now the other thing that we also sort of do is that like I said, that regime modeling is very important for us, like
Mm-hmm.
macroeconomics and things like that are very important for us, right?
Mm-hmm.
So at any point in time, we try to understand what type of market we are in. Is it a trending market or is it a volatile market, right?
Mm-hmm.
So if we are in a trending market, then we keep our constraints very loose. That if we do as much momentum investing you want or as much high risk investing you want, we don't care. But the moment the markets become volatile, we make our constraints tighter, right?
Mm-hmm.
That now try to reduce the risk, try to keep the allocation to high risk factors lower and things like that. So we
Right.
keep that dynamic element in place.
Super. And most of the times, these indicators are, what you say, lagging indicator. Now you get the idea only when the things have happened. Like, what do you do to get some leading sense of it, or you are fine to live with the lagging thing, and you basically get the signal slightly later once that trending regime has started or it has completed. So, what are your thoughts on those parts of the things, and how do you optimize that for a better outcome in your portfolio returns?
Yeah. So for our risk model, right, we try to focus. We don't rely on lagging things, right? So our risk model, the regime model that I showed you, it is forecasting, right? I'm trying to forecast what will be the risk in the next month.
Right.
And because risk is much more predictable than return, risk is
Hmm.
much less noisier, right? So
Yes.
risk is slightly easy to predict compared to returns.
Okay.
And we see
And
good accuracy in our regime model.
mhm.
Uh, on the return side, we don't forecast things. We look at lagging indicators, but we are looking to explore, analyst estimates and things like that going forward in the future. For
Mm-hmm. Now, for somebody who is very new to this field and they don't understand quant very well, how would you explain to a layman? Like, we had some of the very technical terms, but somebody who is a very layman kind of thing, like if you want to break down your entire process into few steps, what would be that entire step by step process?
yeah, so see, this whole process is again, it is coming from a mind of an investor, right? It is not coming from the machine is not doing something on its own, right? It does what you tell it, right? In most cases. So talking from a layman side, right? So the whole process of investing is nothing but everybody, be it a quant investor or a norm or traditional investor, anybody, right? But everybody, what they're trying to do is to get the better return and get a lower risk, right? That is how this thing is designed, right? And then the themes through which or the style of investing is again not anything new that we are doing, right?
Yeah.
Value investors, quality investors, momentum investors have been there for centuries,
Yes.
right? So it is how it is. But yeah, with data, I am able to analyze a lot of stocks together, right? I don't have to focus on 5-10 stocks. I can look at thousands of stocks, right? And I can also look at like any as many factors as I want, right? I don't have to focus on one or two.
Yes. And what is your selling process like? Say for example, you got some stocks in your model and you allocated them. Ultimately, once that review process is there, how does a stock come out of the portfolio? That is a very interesting thing to know, because a lot of people master the process of buying and screening, but then the exit is the tough part, and that is where it is very important to have something slightly objective in place. So what is that you follow in the selling process?
Yeah, so we sort of keep the design of the model itself is such that it will give you a basket at every time, right? Now, in that basket, some stocks will be retained, some stocks will actually exit, and some stocks will be added, right? So we don't have any it is just totally based on the underlying factors and the risk, right? So if let's say a particular stock has gone out of momentum, it will automatically go out, right, from the basket, and any stock that is doing much better will come in. It is defined by the system itself. So we don't take any manual, like I said, manual exits or things like that.
Yes.
And the model itself sort of takes care of that.
And the model also ranks and scores in a certain way so that you have that top bucket. How does that work?
Yes. So for each factor, like I said, when you're doing a momentum factor, it will rank stocks based on the trend that they have, right?
Okay.
When you're doing a quality factor, it will rank stocks based on a particular quality ratio, right? So if you look at this, right? So if you're doing, let's say, a value factor, it will look at book to price ratio, rank stocks based on the book to price, and try to give more allocation to the stocks that have a lower book to price, right? That's it. Yeah.
Understood. So based on all these factors and based on the weightage you might have put in, it will score each and every company in your universe, whichever you have ample of data, and then the data will rank or give a score to each of this company, and then top 10, 15, 20, whatever your portfolio allocation methodology is there, it will pick it up, and when the next review happens, it again checks whether these are the same top 15-20 companies, or there are some new companies which can be added or removed from the existing list, right? Then my question comes in, like, what is the churn factor of generally these portfolio, and whether these churns actually translate into higher beta or higher returns at a portfolio level?
Yes. So obviously, see, we are not like a passive index, right? Like that they would meet any churn. There is churn, right? There is, and the model, if you let it run on its own, it might create a very high churn, right? So we keep another check on top of the model that while you are allocating more to the high momentum or high value stock, try to reduce the churn based on previous month's allocation, right? Don't change too much. So again, we optimize for that and try to reduce the churn, because and this is something that I learned over the years, right? So when I sort of started, I was doing on a weekly rebalance and churning too much, and a lot of feedback came right from the clients who said, "Keep, we don't want so much churn. We want slower rebalance and things like that." So we made our process much more slower in that regard, that we are optimizing. We are not churning too much and taking care of those things, and we were able to find a good balance, right? And deliver decent performance with these things.
Superb. So in current small case strategies which you have, what is the different kind of churn, like whether it is monthly, quarterly? How is the balancing happening right now?
Yeah. So when I talk about our current small case strategies, we have around broadly 6 strategies out there, right? So I can sort of show you those if you want.
Sure, please.
Yeah.
That will give us the idea and connect the theory part with what is happening on the ground. Yeah.
Right.
And
So
by the way, all the listeners, if you want to check out, I'll just share the link also below this video, so you can just check out. She has been doing awesome, and in terms of returns also, it is really good compounding that is happening across all these portfolios.
yes. So our strategy is, I started with a multi-factor strategy, right? What that means is that we're not following one single theme, right? We're not just following momentum or value. We are looking at all the factors and allocating to whichever is doing well right now, right? So this is the one that we started with, which was our balanced multi-factor. This is a monthly rebalanced portfolio. And you will see that in the last almost 3 years, it has been, right? It has outperformed the index by a wide margin, right?
Yes.
This one has 3 versions, right? One is a balanced or a medium risk, one is a high risk, and one is a low risk. So in each of those, if somebody is able to take high risk, then they should go for growth. If somebody is able to take, moderate risk, they go with balance. Somebody is able to take low risk, they do conservative. So in a conservative, you will see that there is higher allocation to low risk stocks or ETFs, right, which are low risk. Whereas in balanced and growth, that allocation will be higher towards equity and maybe high risk equity.
Right.
So this is our multi-factor that we started with, and along with that, we have a number of thematic baskets. Not too many, but some very interesting thematic baskets, right? So the one we have is small caps, where we invest into smaller stocks, right? Not in the top universe of large cap and mid cap, but in the small cap universe using the same methodology. This has also done really well in the 2 years. It has given a 45% CAGR. Then we have our momentum portfolio, which is really popular. I think a lot of people go with our momentum portfolio. This is a trend following strategy, right? It has given, since it started, it has given 116% return and outperformed the market by a wide margin.
Super.
And
so and here, what is the rebalancing again? Is it monthly or quarterly? How does it happen in the
we used to do this on a monthly basis only, but our clients, when the markets become volatile, right, people keep asking about more quicker updates, right? So right now, while the markets are volatile, we look at it on a weekly basis. We don't change every week. We let the allocation stay for most of the weeks, but we're looking at it on a weekly basis right now, right?
Okay. So it's more dynamic, and as the market condition changes, you basically take care of it.
Yes.
Awesome.
Along with momentum, we have 2 more themes. One is a quality portfolio, where we allocate to high quality stocks based on their profitability, growth in profitability, and safety. This has been there for 1 year, and because in the India market recently, quality has sort of lagged and momentum has done better.
Yes.
So you will see that the quality portfolio of ours is also underperforming the momentum, which is because the market has been like this.
Yes, and that is the cycle, right? We see that often, like in 2018, when there was so much of risk off kind of market, they preferred all the quality stocks and they performed very well. And then again, after COVID, the risk on kind of thing has started. So all the small caps and momentum is kind of flavor of the market, and that keeps on changing. And that is a good thing, that you have options for all the kind of set of investors, so that somebody who is not having that kind of mindset and they want to go with high safety and low volatility, they can probably look for these kind of things. Awesome.
Another very interesting portfolio that we started around a year back is the innovation portfolio, right? So this innovation portfolio is a new one where we only invest into futuristic sectors, right? So we do electric mobility, which is EV, and everything from car makers to battery makers to power generators, everything. We have e-commerce, digital, and fintech in this basket, and this basket has done really well, outperformed the small cap index by a margin, right?
Super. So this is basically all the new, sectors and futuristic things which are coming
Yeah,
up.
this
So
is
yeah.
futuristic sectors. We are also actually right now planning on something on the the Atmanirbhar theme, right?
Mhm.
Because
Mhm.
there are sectors which are getting a lot of PLI, right?
Yes, yes.
So those are really now outperforming. So we're thinking of that factor, and that is something that is not a global factor, but it's a very India specific thing.
Yes,
So
yes.
we are doing our research and exploring that also right now.
Superb. So the China plus one and the
Yeah,
PLI
plus
kind
one
of
and
boost which
PLI.
we are getting. Yeah, both
Yeah,
are.
yeah.
So textile and some niche manufacturing, chemicals, all
Yes.
these sectors are picking up.
Right. Yeah, defense and all that.
Yes, the defense is also right now the theme. I think in your momentum also a lot of these names might be coming up. So yeah, that's
Yeah. So we are actually researching on that right now, and we're hoping to do something on that.
great. Looking forward to that. And
Mm.
yeah, for people who are listening to this, all the fellow investors, any message you want to give them in terms of how to understand this space better, and
Mm-hmm.
if any kind of a follow-up reading material or anything which they can
Yeah,
learn on their own, what are your
definitely.
suggestions?
Yeah, so on this, if you go to any of our small case pages, right, you will see all the details of a particular portfolio out here, right? You will see, the philosophy, why you should invest in this, what is the methodology through which we've created. You'll find a nice blog post explaining each of the portfolios, right?
Oh.
So let's say for innovation, we have, why does innovation work, right? I mean,
Hmm.
should be a reason for something to work in the long term, right?
Yes.
So we have given the rationale for it, what types of sectors you can expect into it, and the performance also we have highlighted. You will find the costing also here. Our portfolios are charged conservatively, right? So it is easy for people to go with them, and the investing process with small case is very seamless, very easy. It's a very it's a very good platform. That I really love the experience with it.
Awesome, awesome. And somebody who wants to learn this process, like how to do quant investing, and what are different ways of doing quant investing, what are some of the resources you will guide the investors if they want to go into this journey?
Yeah, yeah, yeah. So for me, I have been like a self learner uh, in this field for a very long time. The idea is, the term that I'm talking about, factor investing. If you go and do a search on it, you will find a lot of literature that you can read. It's very well defined. There's a lot of research work, right? Very public research papers that you can find on platforms like SSRM
Yeah.
that you can read. There is even India specific written research out there that people can analyze. Uh, so that is one thing. Second thing is, there's a lot of content on blog posts and internet content on any quantitative idea that you might have, right? So if you search about, like I was talking about portfolio construction models,
Yeah.
and just search about portfolio construction models, you'll find so many pages that are giving you code for each of those things, right? So
Yes.
that is and if you have to do have some elementary knowledge of Python, I think, and then you will be able to go ahead and start experimenting on your own. So there's a lot of resource content out there. If you want to do a structured learning in this particular field, then obviously there are various open source courses on digital platforms. I did a course with WordQuant University,
Mm-hmm.
which was again, it was not teaching anything exceptional out of the ordinary, but it gave a structure to the learning. So I really enjoyed it because I loved looking at this field. So yeah, there are lot many resources out there, and there's a culture of open source and a lot of sharing of knowledge in this space.
Yes.
So it is something that attracts a lot of researchers, attracts a lot of people who like doing these things, right?
Yes, yes. And again, yeah, it is very niche, like you need a different mindset to do it, and more, I think, statistics and math related mindset also, which helps you to do that.
Right.
Awesome. So great having you here, Sonam. It was awesome interacting with you for last 45 minutes or so. All the best in your journey, and thank you so much for taking out time and sharing your knowledge and wisdom with all the fellow investors.
No, thanks a lot, Vivek. I've been following you for a long time, and I really appreciate the, the community that you have built. And thank you for having me here. I
Thank you
really
so much, Sonam. Thank you.